For 5 days in 1907, New York's financial markets simply stopped functioning. The Panic of 1907 wasn't just a blip. It was a systemic collapse, a run on banks, and a desperate scramble for liquidity that nearly crippled the nation. This crisis exposed a critical flaw in the U.S. financial system: the absence of a central authority capable of stabilizing the money supply and preventing widespread contagion. For decades prior, the U.S. had resisted a central bank, wary of concentrated power. But the panic, eventually mitigated by private financiers like J.P. Morgan, forced a re-evaluation. The result was the Federal Reserve Act of 1913, signed into law by President Woodrow Wilson. Unlike a single central bank, the Federal Reserve System was designed as a decentralized structure. It consists of a board of governors in Washington, D.C., and 12 regional Federal Reserve banks located across major cities like New York, Chicago, and San Francisco. This structure was a compromise, aiming to balance national interests with regional concerns and private banking with government oversight. Each regional bank serves its district, holding reserves for member banks and providing services like check clearing and currency distribution. The Federal Reserve's primary objectives, as mandated by Congress, are to promote maximum employment, stable prices, and moderate long-term interest rates. To achieve these, the Fed employs several tools, notably open market operations. Through open market operations, the Federal Reserve buys or sells government securities in the open market. When it buys securities, it injects money into the banking system, increasing liquidity. When it sells, it withdraws money, effectively tightening credit conditions. Another tool is the discount rate, which is the interest rate at which commercial banks can borrow money directly from the Fed. Adjusting this rate influences banks' borrowing costs, thereby affecting their lending to businesses and consumers. The Fed also uses reserve requirements, which dictate the percentage of deposits banks must hold in reserve. Changing these requirements impacts the amount of money banks have available to lend, influencing the overall money supply. Over its history, the Federal Reserve has evolved, adapting to economic shifts and crises. Its actions, from managing inflation to responding to recessions, profoundly influence the financial stability and economic trajectory of the United States, and by extension, the global economy. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe if you're curious about how complex financial systems fundamentally operate. This video is for educational and informational purposes only and is not financial advice. Always do your own research.